Somewhere, right now, a pension fund is sitting on a problem. They put hundreds of millions of dollars into an investment back in 2021. Smart move, great returns, everything going to plan. Then 2023 hit. Markets got weird. They needed their money back. So they called their fund manager and said, "Hey, we'd like to withdraw." And the fund manager said, "No. No fraud, no bankruptcy, no scandal. Just a very polite, very legal, very contractual no." This is the story of private credit, the $2.5 trillion industry that's quietly taken over Wall Street, made a new generation of billionaires, and built a system where your money goes in easy, but getting it out is a whole different story. You've probably heard about private credit from some finance bro. You know the type. Patagonia vest, Red Bull in hand, nicotine pouch lodged so deep it's basically part of his personality. But in case you haven't, here's the gist. Imagine you're a company that needs a loan. 30 years ago, you'd walk into a bank, dap up some banker named Tucker, and boom, loan approved. No stress. Tucker didn't care about your credit score or the fact that your last company was a failed vape shop. But that era is dead. We'll get to why in a second. Today, when a mid-sized company needs money, they often can't get it from a bank. Too risky, too much paperwork, not worth the headache. So who shows up? Private credit funds. Firms like Blackstone, Apollo, and Ares. They say, "The banks ghosted you? We've got you. Just sign here, pay 10 to 15% interest, and we'll tack on a few fees." It's like Venmo, except your buddy isn't sending you $20 for pizza. He's wiring $200 million to a mid-market oil refinery so it doesn't go bankrupt. To understand private credit, you need to understand what broke the old system. Rewind to the early 2000s. The private credit market was tiny, about $140 billion globally. A weird sibling of private equity, niche, ignored, nobody cared. Meanwhile, traditional banks were having the time of their lives. They were handing out loans like candy on Halloween, including the now infamous ninja loans. That stands for no income, no job, no assets. Yep, banks were literally giving mortgages to people with nothing.
But it gets worse. Banks started bundling these steaming piles of questionable debt into products called collateralized debt obligations, CDOs, basically taking a bag of risky loans, slapping a bow on it, and selling it to investors as a safe product. And if that wasn't reckless enough, they invented CDO squared, which was CDOs made of other CDOs, ticking time bombs inside ticking time bombs. Financial inception, except nobody woke up. And then in 2008, shocker, it all came crashing down. The banks had blown up the global economy by handing out loans to anyone with a pulse, so regulators stepped in and said, "Okay, playtime is over." They forced banks to increase capital reserves, cut leverage, and actually check if borrowers could repay. Revolutionary concept, right? The result? By 2010, traditional bank lending to small and medium-sized companies had absolutely collapsed. These were companies too big for community banks and too small to issue bonds on Wall Street. They were completely stuck. And that gap, that's exactly where private credit walked in. Private credit funds stepped up and said, "Don't worry, we'll lend to those companies the banks won't touch. We'll just charge more for the privilege." And companies lined up, fast. In 2010, private credit assets under management sat at around $300 billion. By 2020, over $1 trillion. Today, more than $2.5 trillion. That's a 10 times explosion since 2007. For context, that makes the global private credit market bigger than Canada's entire GDP, which, okay, it's Canada, but still, that's a lot of money. Private credit went from being the weird, ignored sibling of private equity to being Wall Street's favorite money machine. So what made it so irresistible? Over the last 20 years, private credit returned about 9.6% annually. The stock market, about 10.2%. So private credit slightly trails stocks. If that's the case, why are trillion-dollar funds losing their minds over it? 2 words: stable returns. Stocks can swing 20% up or down in a single year. A single week! Jerome Powell can clear his throat at a press conference and your portfolio loses 3% before he finishes the sentence. Private credit is smooth, boring, and consistent. It's the Goldilocks asset. Too risky for banks, too safe for hedge funds, and just right for anyone managing other people's money. Pension funds, university endowments, insurance companies. These are institutions managing $30 trillion in assets. They don't want roller coasters. They want to know the number will be slightly bigger next year than it is today.
Private credit gives them equity-like returns with bond-like volatility. And after a decade of near-zero interest rates where bonds paid basically nothing, private credit became the obvious answer. Perfect, right? Well, about that. Here's the part nobody puts in the brochure. When you invest in private credit, your money is locked up. We're talking 5 to 10 years, sometimes longer. Why? Because these are direct loans to private companies. There's no stock exchange to sell them on, no buyer waiting on the other side. If you want out, tough. You signed the contract. And the contract has some fun features. Lockup periods. Your money is committed up front, full stop. Gates. Even in semi-liquid products, funds can legally block withdrawals if too many people want out at once. No secondary market. Unlike stocks, you can't just sell your position to someone else. Valuation opacity. Nobody actually knows what these loans are worth until a borrower stops paying, and even then, it's kind of a guessing game. For decades, nobody cared. Returns were great. Everything was stable. Who needs liquidity when the money's quietly compounding? Then 2022 happened. Interest rates shot up faster than they had in 40 years. Suddenly, companies that borrowed at 6% were paying 12%. Some started missing payments. Investors got nervous and wanted out. And the fund said, read the contract. That's not a villain origin story. That's just the deal. The problem is, a lot of people didn't fully understand the deal when they signed it.
Products called BDCs, business development companies, started letting everyday investors into private credit. Your financial advisor's wealthier clients, the dentist with good savings, anyone with $25,000 and a moderate risk tolerance. The pitch? Get institutional grade returns. Everyone's doing it. The problem? Regular investors have shorter time horizons. They have emergencies. They have kids. They panic. And they absolutely do not read 200-page investment documents. When they needed their money back, they found the same locked door. Just this time, they weren't prepared for it. The IMF has flagged this. Regulators are nervous. Academics are writing papers. And yet, the money keeps flowing in. So is private credit the greatest financial innovation of the last 20 years? Or is it just the latest bubble wearing a slightly more boring suit? The optimists say loans have covenants, there's collateral, default rates are still manageable. These aren't ninja loans, borrowers are actual businesses with actual revenue. The skeptics say $2.5 trillion grew in a single decade with almost zero stress testing. Zombie companies are multiplying, businesses that only survive because the loan keeps getting extended. Regulators have almost no visibility into this market. And now, retail investors are in the pool, people who will absolutely panic when things get bumpy. Nobody knows. And that's actually the most honest thing you can say about private credit right now. The whole industry runs on one assumption. Borrowers will keep paying. And for the last decade, they have. But an assumption isn't a guarantee. It's just a bet that hasn't been called yet. Private credit isn't evil. It fills a real gap. Businesses get funded, investors get returns. The system mostly works. But the version being sold to regular investors right now, that's a different product wearing the same brand name. Know what you're buying. More importantly, know what you can't sell. Because in private credit, the fine print isn't fine print. It's the whole deal. The money keeps flowing, the returns keep coming, and everyone keeps pretending the music will never stop. It always does, eventually. The question is just whether you're near the door when it does. If this video made you smarter and slightly paranoid about your pension, that's exactly how finance is supposed to feel. Subscribe. We'll keep ruining things you thought were fine.